Hello, listeners, and welcome to the Montel Weekly Podcast. Bring energy matters in an informal setting. This week, we discuss gas and Europe's energy crisis. Everywhere you look, energy is in the headlines as prices surge. Households and industry face soaring costs, perhaps for many years to come, if we are to believe some bosses of UK energy firms. And this is largely on the back of soaring gas markets. Now, what's the reason for the crisis? Is Putin to blame, as the IEA director Fatih Birol suggested this week, or are there other factors at play? As we record, prices have softened, but will they stay that way for the weeks and months to come? Joining me, Richard Sverrisson, to discuss these issues is our old friend Trevor Sikorski of Energy Aspects. A warm welcome to you, Trevor.
Thank you very much, Richard, and as always, a pleasure to join Montel.
Let's go straight in and discuss current prices. They have softened. This is the wholesale gas prices, both in the continent and in the UK. What's the reason for this?
Well, I think the softening that you're seeing at the start of this year is a couple of things, but I'd say there's two main drivers there. And the first one, of course, is always kind of weather, and certainly was a very mild end to 2021. And whenever you have those, that peak winter not being that cold, it really kind of helps soften demand. And with softening of demand, people's views of scarcity, how much scarcity there is in the market, starts to come off. And so we really saw that, and certainly even for the first half of January, even if it's not been that mild, it hasn't been really, it's been around normal or slightly better than normal in terms of temperatures. So again, not the big draw on storage that demand could have brought had it been a lot colder. So I think you're seeing some of the winter risk ebb away as we go through the peak winter, and really cold weather hasn't really shown up. I think the second big one is, of course, as well, LNG, and LNG send-out's been really high, and we've had a lot of LNG. You could say this is also weather, but it's not European weather driving that. It is of course, Northeast Asian weather largely driving that, because, the Northeast Asians went in to, I think, this winter really highly bought with a lot of gas in storage, and they've had a very mild winter. Lots of concerns about La Nina going into the winter. We did some analysis that was quite interesting. Really said only with La Nina year, you only tend to get 1 month of very cold temperatures, and that tends to be January. Maybe in the second half of January, we might see a little bit of that, but December really, really mild, far milder than normal and milder than expected for a La Nina year. And that really just meant that, the Asians weren't burning through their stocks. And a lot of that is terminal stocks. So, if you've got a lot in your terminals, you just aren't, if anything, you're going to be turning away a few cargoes because you just don't have room for it. And we saw a bit of that. And of course, that just weakened that, sent a lot more cargoes into the European space. The other thing as well is we've seen a lot of overperformance probably from a lot of LNG supply. And of course, with LNG prices where they are, you're looking at, around, they've been around $30, maybe a little bit less with some of the recent changes in the TTF. But, very, very high gas prices, huge amount of incentive to get gas onto the water if you're a producer. And of course, we've seen, a lot of production probably over what you'd say nameplate capacity is of facilities. We've seen that from the US, we've seen that from Australia, all of the big producers really being strong in terms of their production. And that has pushed probably more LNG than expected as well into that European market. So those two drivers being really strong for LNG send out, that has helped limit the draw on stocks and has kind of eased those concerns about end of March storage, which were so important, even 6 weeks ago, or even probably 4 weeks ago, before before the weather happened and before LNG happened.
We saw, in December, prices peaked all-time highs of 188 euros per megawatt hour. They've come down to around 70, 80. What's your view going forward here in the weeks and months to come, Trevor? And what is it all about the weather now?
It's always about a couple of things.
Sure.
The two drivers that have helped soften it are going to be really important, right? So if you see a flip in either of those two drivers, i.e. the weather or the LNG imports, then you'd say, well, there's a bit more upside probably into pricing to come. you would again start to see a bigger draw in storage, and that would worry, the market a bit, and there would be a little bit more risk priced into that market. Possibly not as high as what we saw, in December, because there's less of winter left. So probably the risk profile looks a little bit better than it did back then, but you could still see prices going reasonably high if either of those two switch. And then there's the Russian question, and that Russian question, of course, is incredibly important, and has been something which means, yes, we're talking about prices coming down, but historically, even even the 70 euro price is incredibly high for the European market, historically at levels that, we've never seen before. So, very, very high, very expensive gas expected for the rest of the winter. And for the summer, because even with some softening, expected probably, on that curve, it's still not really going to be a place where we're going to be able to burn a lot of gas into power. So those pricing dynamics are going to keep the curve reasonably high.
So you think around 70 euros a megawatt hour, then that's where we'll stay until the summer?
Well, I mean, like I said, I think, if any of those two, if weather changes, LNG changes, then of course there's upside. Has the market finished repricing? It's kind of wait and see, as we get further and further through the winter. If we continue to have an end of March which looks satisfactory and comfortable for the market, maybe you see a little bit of easing. But certainly for that strip from now to the end of summer, prices are going to have to stay historically reasonably high, i.e., at the top of the fuel switch range, if not higher. And they've certainly been a lot higher than the fuel switch range over the last couple of months. So that kind of support is still going to hang out in the market.
I mean, I want to return to the fuel switching levels and the dynamics there, Trevor. But let's return to the Russian question. So the pipeline gas and the scarcity, is it all about Putin, as Fatih Birol was hinting this week, or suggesting, not really suggesting, it was clearly stating and blaming Gazprom for the crisis? Is that too simplistic?
I mean, it's, certainly if you looked earlier in the year, it was a combination of, Asia bidding away a lot of the LNG from the market, it being pretty supportive in terms of weather, renewables was low. You had a whole bunch of things kind of adding into this, and it was very cold in Russia. And I think last time we talked, we were, kind of sympathetic, at least over the first half of the year, in terms of, the Russians needed to fill supply and or needed to fill domestic storages, which were incredibly low, and had increased production a lot in order to do that. So we were reasonably sympathetic to the idea that the Russians didn't actually have very much incremental gas to supply into the market. Kind of 6 months on, that sympathy is eased, I would say, or has waned a bit. A couple of things happened. First of all, if you'd looked over the previous couple of years, Gazprom was always refilling domestic storage to, between 72 and 73 BCM. And when they hit that, it would have maybe been a signal that they could have sold some additional gas into the market. And of course, they didn't do that. And they seem to be relying very heavily just on nominations. They've effectively stopped selling on the ESP. So, and then they filled up their storage, to 75 domestically. And that means that now they do have a lot of gas in storage. And certainly to the end of December, you would have said, they have been preserving domestic stocks at the expense of selling any incremental gas into the European market, and given how high the European market is pricing, that does feel like there is a degree of withholding supply from that market for whatever reason. And, and we do certainly, internally, we have lots of debates about, what are the Russians, actually doing here? Is it just about getting Nord Stream 2 online? I mean, everyone's kind of, agreed and at least publicly recognized that this is just a regulatory set of hoops that the Russians have to jump through. It's at the moment, there isn't a big external threat to it anymore. That could change depending on if the US votes for heavier sanctions. But the Biden administration has gone very soft so far on that. So it did seem like this was just a Benetza kind of hurdle that the market, that the Russians had to get over. So why why continue to withhold gas from the market if there's such a big profit to be made? Now, you could say, well, they're making a huge amount of profit anyways, because obviously the lack of Russian gas into the market has kept it very high, and you're seeing, kind of record, profitability, let's say, for Gazprom this year, even though it didn't sell that much gas into the European market. And that's because so much of it's now hub indexed, and Gazprom is kind of, if you'd say, using its market power in a way to maximize its revenue at the moment. And that's really kind of where we feel like we've got to now. How long does Gazprom do this and let LNG wash into the European market, and take that maybe potentially for a very long time? They have come out recently and said, you guys need to sign up to some long-term contracts. If you sign up to long-term contracts, then we will provide some more gas. Now, this is a little bit of a change of tact, but it kind of makes sense, because if you're Gazprom, you have to be worried about, the direction of travel for for their European gas market, and, the decarbonization that's expected to happen over the next decade in the power sector, with lots of, the member states, really looking for significant increases, in the decarbonization of power, which means really hollowing out what you have for thermal generation. And yes, coal's going to take a hit on that, but you'd expect gas is going to take a hit on that as well, of course. So they could be like, well, let's get the utilities to lock in longer contracts, and we've seen maybe some of the more southern, less market focused, or those markets with less developed gas markets, signing up. We saw Greece, we saw Turkey, in the last month or two, signing up to some longer term contracts from the Russians, and that, maybe that's what they're trying to push. It's basically like saying, forget about the ESP. We're not going to do ESP sales. You want more gas from us, you commit to a period. Hard to see maybe the utilities, going for maybe another 5-year strip of gas or something like that, given, if you look at investor reports and stuff like that, it's all about, amongst the utilities, it's all about renewables, it's about batteries, it's about EV charging points. It's about the energy transition. It's not about renewables, and that's not the story you want to sell investors if you're a European utility.
Yeah, it's not about gas, you mean there, Trevor? Yeah.
Well, yeah, it's probably not it's not really about gas anymore. And gas, we certainly believe gas, will have to play a transition role, and it's just a question of how do you manage that transition role. And certainly it's not probably increasing demand, but do you need to keep gas around because you are going to expand power demand through the electrification of transport and other sectors? You're probably going to increase electricity demand from the increase in green hydrogen. So you've got all of these things that are going to draw on renewables. So you are still going to need some of the existing capacity just to meet underlying demand. So there's this really big question. Unless you have a really, really big increase in energy efficiency, demand's going to go up. If demand's going to go up, renewables will struggle to do everything that's going to be asked of it, which is meet higher demand, replace coal, replace nuclear, and potentially replace gas. That becomes very difficult. So we think, gas definitely has a role to play through the coming decade, maybe a little bit longer, but then it is getting a little bit thin. And are you going to get utilities saying, yes, I'm going to happily commit to a very long period of gas demand? And the answer is probably no. Maybe there's this little window now where they say, yes, gas has this transition rule, I can sign up for 10 years, but maybe 5 years is a more realistic for anybody wanting, that those Russian gas flows. And is that enough for, Gazprom? Is Gazprom going to be? I mean, I'm guessing Gazprom might offer that, but it is a big question.
Yeah. So there's a combination of geopolitics, as we're seeing now with tensions on the Ukraine border, as well as trying to secure these long-term deals for the long-term demand for its product. But when it comes to Nord Stream 2, Trevor, what kind of analysis have you done, and when do you expect the pipeline to start operations?
Yeah, I mean, I think last time we talked to you, we talked almost exclusively about Russian questions and NS2, and at that point I think we were quite pessimistic. We basically said Nord Stream 2 is not going to start probably till the end of Q3, and certainly nothing that's happened, in the last 4 or 5 weeks has really changed our view on that. We still think it is, an end of Q3 type of time frame for them to get authorization. Now, like you said in your previous comment, there is a couple of threats to Nord Stream ever coming on. One is U.S. sanctions, but the other is, all of the conflict, on the Ukrainian border. And certainly, if you have, any kind of, Russian incursion into onto Ukrainian soil again, it just seems very hard, politically then for the Europeans to switch on, Nord Stream 2. And that becomes, a pipeline that looks almost dead in the water, and these are two big threats to Nord Stream 2, the tension on Ukraine and U.S. sanctions, and certainly the Europeans would be much more relaxed with very heavy U.S. sanctions on that pipeline if you do have an invasion of Ukraine by the Russians.
Moving away from the Russia question a little bit there, Trevor. I mean, the other aspect that you haven't touched on, which could, be throw a spanner in the works here, is the impact of French nuclear outages or a lack of availability here. Have you? What are your expectations for the coming months? I mean, it's always a bit of a wild card, the extended outages, sudden unplanned stops, etc. What kind of impact do you see this having in the coming months?
Yeah, I mean, this is certainly one of the things, when you looked at, when you look at 2022, either gas burn in power or the need for thermal, let's say, and emissions as well. You look at both of those and you'd say, well, power is going to be another year of year-on-year increases. Because you've got a whole bunch of kind of nuclear questions. Certainly, you've got the loss of 4 gigawatts at the beginning of this year of German nuclear. You've got EDF, again pointing to, after 2 years of kind of recovery of nuclear, a very, a weak year for nuclear generation from the French. So you've got, low nukes is going to be a question. I mean, I think the one thing that might save that in terms of year-on-year increments, of course, is last year. 2021 was such an outlier in terms of, wind speeds and that sort of thing. It was not a great year for wind availability. And of course, a lot of new wind capacity, new solar capacity came on in the EU last year. And again, we expect that probably to happen again this year. You're looking over, well over 20 gigawatts of additional renewables being added. There's a lot more capacity. It was just, you had, kind of an extremely calm year in terms of weather patterns. You would expect some degree of normalization on that. And that's the one thing that's maybe going to offset that, or potentially partially offset that big loss of nuclear that we're seeing this year. Of course, you also have a number of coal-fired power generation being shut down in the block as well. And all of that just kind of adds to some of the pressure on the European gas market, just because you are getting less fuel switching. You're getting what we saw this year was as gas moved through the fuel switch steps, and priced itself increasingly out, you were getting less demand side response, partially because coal was tight as well. But you were getting less demand side response from the coal sector than what we expected, to see from previous years. And so, that is one of the things that's the transition is going to bring, is as you get rid of coal, gas will become a less flexible market. It will become a more volatile beast, because you don't have that safety net of, we can just take it out of power and let coal generation take up the slack. That's just not going to be there anymore. So it does make it a much more volatile set of markets, both the gas market and, of course, the power market.
But that's more in the medium term. I mean, I'm thinking this year we've seen record high carbon prices, up to nearly 90 euros a ton. Yet you've seen this switch from gas to coal-fired generation. I mean, what would it take to flip that back to coal to gas, which is what the carbon market's there to do in a sense?
Yeah, I mean, I guess, and we've said it for a couple of years, and we're probably have been a little bit of outlier, but we've kind of, had for a while, the basic premise that the carbon market will be ineffective in the coal to gas switch, because you price on all of the gas you need at such a low price that it's not the carbon market that can then stimulate more gas-fired generation, because you're already maximizing out supply at very low gas prices. So it doesn't provide that short-term abatement. What provides that short-term abatement is development in the gas market, right? So when gas gets cheap against coal, then because that's happening because there's less demand than supply, and so that market is flexible and is trying to get more demand and is pushing coal out. And that's what needs to happen. If you want to get back to the coal to gas switch rather than the gas to coal switch, you need the gas market to soften. And really, the carbon market, the fact it's higher just means that the fuel switch range happens at a higher place than it would otherwise do. So it's kind of inflationary for gas, but it doesn't, a high carbon price doesn't actually drive that switch in any material way. It is just the dynamics in the gas market which is important for that switch.
Yeah, and as you said earlier, you don't really expect to soften until the latter half of this year, the gas prices. A final question, Trevor. You mentioned at the start, US LNG coming in. What's your view here in the coming weeks and months, and to what extent will this help Europe and the supply situation within Europe?
Yeah, I mean, like I said, a number of things happened, and it has been, one of the key reasons behind the softening in gas prices that we have seen, coming off those really, really big highs you mentioned about. I mean, we generally, we're still reasonably constructive now in terms of how much, LNG we did have in our previous balances. We only saw January as being reasonably low in terms of incremental supply, and then we had quite a lot of incremental supply coming in February and March, and that was because we'd assumed a reasonable degree of normalization of Asian weather, and because Asian weather was so cold in December and January, from December 2020 into January 21, you just had a lot of restocking in February and March, and that restocking is going to be pushed later and later into the year, because the Asians at the moment don't need to do that. There's a lot of, there's enough backwardation in the curve to say use up stocks and just sell your cargoes back into the market. So I'd say for the rest of Q1, it looks pretty good for LNG back, coming back into the European market. We expect, reasonable size incremental chunks of that to continue to happen for the next, for the next 2 months, and really, maybe softening a little bit when you get into the summer, but generally, I would say generally through this year, we're reasonably constructive of increments coming in. Last year was reasonably low in terms of the amount of LNG supply. So year on year, we do expect more LNG supply to come into the market. That doesn't really fundamentally, it allows a softening of prices. It probably allows prices, and the risk profile to come down quite a lot. Does that mean, we're going to move from historically high gas prices? It probably doesn't mean that's going to happen this year.
But we won't see those extreme spikes that we saw, say, in December, potentially.
Certainly that's not our base case. You can certainly, I mean, some of the things we expect to happen is, Russian flows at the moment are incredibly low. We do expect that those are going to have to step up just to meet, the contracted quantities we're even below contract numbers at the moment. I think there's a reason for that, which is, the way the indexation, a lot of those contracts work is on an N+1 indexation. So that indexation number for January was set, above 100 euros per ton. So, if you're a contract holder for the Russians, basically the economics is saying don't nominate in January, and that's what we're seeing, right? So, if it got cold, those economics would probably change, and probably the day ahead price would then start going above the contract price, and when that happens, you get a return to nominations. But with the Russians not using the ESP to sell any incremental gas into the market anymore, a lack of nominations just means a lack of Russian supply. We do think that has to pick up and that has to change, and probably the month ahead index will for February should be. Well, it should be less than 100 anyway, so it will fall. Whether or not those dynamics hold for another month remains to be seen, but, until we get out there. But At some point, you would say those nominations have to pick up and then Russian floats have to pick up just to meet contracted numbers. So that's a risk, whether or not people don't do that just because, they don't do that for a couple of months, maybe a little bit of an upside risk. But yeah, I mean, as with all of these things, fundamentals can change pretty quickly. If we do have a month of cold weather in February or something, then all of a sudden the summer looks, it will look tighter again, and all of that will happen.
So the ESB being the electronic sales platform that Gazprom uses to sell gas into Europe. Yeah, exactly. So Trevor, thank you very much. That was a fantastic overview of what we can expect in the coming months. Thank you for joining the Montel Weekly podcast.
Thank you very much for the invitation, Richard. Always a pleasure.
All the best. So listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or, let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify, or wherever you get your podcasts from. Thank you and goodbye.